Crypto trading strategy is an efficient trading strategy. It keeps you from making rash and impulsive judgments that can cost you a lot of money. If you are a beginner, you could even consider trading on the Bybit Futures testnet to become familiar with the world of highs and lows. Subscribe to PILT. Here are some of the common strategies that are popular among crypto traders. Day trading. The strategy of crypto day trading entails entering and exiting a position in the market on the same day within crypto trading hours. It's also known as intraday trading because trades are typically started and concluded within a single day. Yes, day trading BTC is like playing with Bitcoin volatility throughout the day. Watch our video on crypto day trading here. The entire point of day trading cryptocurrency is to profit from tiny market movements. Because cryptocurrencies are volatile, day trading in the crypto market may be pretty rewarding. Trading strategies are devised using technical analysis by day traders, but it is a time-consuming and risky strategy that is mainly suitable for advanced traders. HODL Buy and Hold. HODLing is an investment technique devised from a misspelling of hold, in which people buy cryptocurrencies and keep them for a long time. This permits investors to profit from an increase in the asset's value. So, how to take profits in crypto with the HODL strategy? HODLing lets investors take profits from long-term value appreciation when they invest for an extended period. Investors can benefit from the HODL strategy since they are not subject to short-term volatility and can avoid the risk of selling low while buying high. As cryptocurrencies have a short history compared to commodities like gold and silver or fiat currencies like the United States dollar and euro, they are prone to fraudulent activities such as money laundering. Therefore, some countries may not support cryptocurrencies, affecting the value of digital assets. Crypto futures trading. A crypto futures trading strategy involves entering into a contract agreement between two parties to buy and sell a particular amount of an underlying cryptocurrency, like BTC, at a predetermined future price on a predetermined date and time. Futures trading strategies provide you access to a wide selection of cryptocurrencies without requiring you to own any of them. For example, individuals who hold cryptocurrencies can use futures to protect themselves from market fluctuations. So, how can you trade cryptocurrency with future contracts? Drop USS an email for our guide on crypto derivatives to understand how to trade Bitcoin futures. Arbitrage trading traders rely on arbitrage opportunities to earn profits through cryptocurrency or Bitcoin trading strategies. Arbitrage is a trading method in which a trader purchases cryptocurrency in one market and sells it in another. The spread is the difference between the buy and sell prices. Traders may be able to book profit due to the differential in liquidity and trading volume. They register accounts on exchanges with a significant price discrepancy for the cryptocurrency they're trading to take advantage of this opportunity. An example of arbitrage trading. Related, Binance versus Coinbase. How do they compare? However, the traders need to pay a deposit, withdrawal, and trading fee twice, reducing your take-home profits. Also, if you miss the price difference on two exchanges, as mentioned above, you cannot capitalize on that arbitrage opportunity. High-frequency trading HFT strategy entails the creation of algorithms and trading bots that aid in the speedy entry and departure of a crypto asset. The design of such bots necessitates a thorough comprehension of complicated market principles and a solid foundation in mathematics and computer science. As a result, it is more suited to experienced traders than newbies. Arbitrage, market making, liquidity detection, and momentum trading are four sorts of HFT strategies. As previously stated, arbitrageurs look for price differences between two identical assets and benefit from the price discrepancies on different exchanges. HFTs could utilize latency arbitrage to exploit these misalignments, which are frequently induced by low latency. Stay safe in Web3. Learn more about Ledger Hardware Wallet, link in description. Four types of high-frequency HFT trading. Quant traders utilize HFT, which is an algorithmic trading approach to benefit from bid-ask price discrepancy to sell buy assets in microseconds using latency. However, short-term price differences are spotted by trading following momentum strategies to act on anticipated reactions to the volatile crypto market. Liquidity detection systems rely on recognizing the market engagements of other traders, frequently institutional investors. Moreover, their primary purpose is trading on other traders' market activity. However, please note that algorithms can react to market conditions in real time.